Cool. Let's get started a bit. I mean, we can do the whole, you know, tell us about yourself, how you got into crypto thing.
Yeah.
I heard a little bit on your the Goldman Sachs guys podcast. I actually really enjoyed that podcast. It was a really good one. You went on some pretty good rants that I enjoyed. So yeah, just go ahead and introduce yourself, introduce Abacus, all that.
Yeah, so first off, thanks for having me. So I am the guy who started Abacus. I got into crypto probably around almost a year and a half ago. Oh wait, that's 2023. I think 2.5 years ago now. Wow, that's a trip. Yeah, I got into crypto a while ago. So yeah, I got into crypto beginning of 2021. Basically, I was just in math class and we were just looking for things to study, and I had just discovered NFTs, and so I was like, oh, there's this NFT, it's worth a bunch of money. What is it? So I started reading about it, and then I suggested to like this group that I was in. I was like, hey, why don't we start researching this thing called crypto? Like, it was kind of getting bigger at the time, but I was like, why don't we just look into it in a more technical way? So we started doing that, and then just the group kind of slowed down, but I just was super interested in crypto, specifically for the reason of how, like, it's like I mean, it's pretty interesting. I think, and this maybe we could talk about later, but I think it's a little lost on us now, this part of crypto, but it's one of the essence of it that really got me into it was from the foundation of it all, or a lot of it, which is digital signatures. From that first paper, there's no massive examples given. There's no like super out there, like if you have a whole nation running on this is why digital signatures are so important. No, the example was if you want to trade with a broker and you want to keep the broker honest, you can use a digital signature. Here's why. And it would just go through. And in that example, it went through like some incredibly just simple, but like it sneaky intuitive examples of what might the broker do and how does the digital signature adapt to solve that. So that just got me really into it, like them kind of thinking of all those little things instead of thinking in the mega abstract. And so then I just got really into it, and I read a bunch of stuff. I read about digital signatures, block timestamps, like this thing sending digital mail, and this was starting in the 60s going through the 80s, 90s. And then I read a bunch of white papers, like a ton of white papers, just pretty much read everything I could get my hands on for like 6 months. And then I started learning how to code shortly after that. Like 8 months in, I started learning how to code. And Abacus started us some open source coding project where I would literally get on my Discord, share my screen, and then there would be like 3 or 4 people that were in the Discord at the same time, like 3 or 4 people total. And we had a whole following of 12 people on Twitter at the time. And this one guy who knew how to code, I had no idea who he was. He just happened to find us, and he would just come on while I was streaming, and I'd be doing something. He'd be like, "Oh, there's a better way to do that," or I'd be trying to figure something out. He's like, "Oh, here's how you do that." And that's how it started. And the goal of it started with to just be able to have something which you don't rely on any outside force to help price anything in these loans, or in this online kind of autonomous world that we're all trying to build with crypto. And uh, and that you can use this mechanism as a backbone to actually execute loans or execute these different sorts of financing for anyone who needs it.
Yeah, awesome. I think one of my favorite points that you did or that you talked about on the NFT Finance podcast was the actual conversation that led to advocate the idea. And I know you have like a lot long term like beliefs on where the whole NFT ecosystem ends up and how Abacus plays a role in that. We'll get into that later, but I just want like for the audience and people that are going to listen to this later, just a little more on that story of how that idea came about because I just genuinely enjoy that story.
Are you talking about the one where I was on the phone with a friend of mine?
Yeah.
Yeah. Okay. So basically, when I was getting into crypto, I was, I have like a very close family friend of mine who was like, "Hey, I'm talking to this guy. He's putting together a fund or something, and he, wants money. Can you like join this call and like, I think you'd be one, I think it would be cool for you to meet him, but two, like, can you tell me if he's like just building something which does nothing or if he actually knows what he's talking about? So I was like, yeah, sure, no problem. So I get on the call and we're just talking, and then he asked me to tell the guy like what I was kind of what I was doing, or he asked me to start to, we're basically talking about DeFi and all these things. And he said, he was like, wouldn't it be so cool if you could use something like DeFi to get a loan on your house, like the way you would go to a bank and get a loan on the house. Wouldn't it be so cool if you could use this thing DeFi to do that, right? Or to get a down payment. To buy a car, you put a down payment, but the rest, it's almost like buying a car is like a glorified buy now, pay later, right? Put down a down payment, you pay it off over time. And I was like, yeah, that would be really cool. But then the question popped up of like, but how do you price these things? Right? Because you need some thing that exists alongside it, alongside the infrastructure on chain that helps determine the price and helps determine the actual terms. And that's what got me thinking about it. I was like, huh, that's an interesting problem to work on. And so yeah, that's kind of the origin story. I can't believe that was a year and a half ago now. It's pretty crazy.
It's all a blur, huh?
Yeah,
The past couple
it
years.
really is all a blur. It's all just mixed together. It's pretty crazy.
Yeah. I really enjoy that story. Like the way that, you know, the whole project and everything that Abacus is doing comes from just a random conversation. It's awesome.
Yeah, that's
I actually, one of the questions I wanted to know a bit more about that you guys didn't, I know you have, or you had another team member that came on the NFT Finance podcast, but and I know you talk a lot about, you have some hot takes about like DAOs and how you guys plan on developing like treasuries and stuff. But I'm just curious, what's your team look like now? And, maybe if there's one in the crowd or listening to this that could contribute in any way.
so we have a pretty small team. It's like me, full stack, and just all around Swiss Army knife, product guy, community guy, just general education, designer, kind of does everything. And right now, we're just super tunnel visioned on what we're trying to do in terms of what we're doing now. And then, like, we spent a lot of time focused on the protocol itself, and we need to spend more time focused on like just full on outreach, which is not something that I think we need more manpower for. So we're not really necessarily looking to hire, but I mean, if you reach out, if someone here is listening or someone's listening in the near future, if they reach out there, there's always a chance that it just kind of clicks. But I tend to think that protocols in general don't require massive teams, right? Like if you think about a lot of these protocols that exist, a lot of what happens in spurts, right? Like you have like, for example, Aave or Uniswap, right? There's four versions, or there's three versions of Uniswap. And like, yeah, sure, they've updated the interface a little bit and maybe they put out some research papers, but like the actual product itself has had three versions, maybe a few interface updates. And now they bought a couple other things, right? They bought Genie and whatnot, and now they've built a wallet. But that's all in, I think, what is it? They were around in 2018. That's in 5 years, which is not a knock on that. That's not what I'm trying to say. My point is that probably one of the biggest protocols and most used protocols that exists over 5 years has only really had to put out like six major things. And that is something which is like, a big, that's just like indicative that it's like spurts. Whereas in a traditional business, right, it's not as big of an overhaul to update the code constantly, to make it run more efficiently, to kind of play around with adding certain things and removing certain things, like we're seeing with Twitter right now. And for that, you need more dev power, right? You need more designer power. You need more product power because you need to constantly be like, oh, this didn't work. Let's replace it with this. Whereas when you're working with smart contracts, that's the kind of point of it. And it can also be seen as almost a negative trade-off, which is that you're putting these things out and it's not as fast as iterative experience. It's more like, okay, I worked on this in the theoretical sense for months, and now we're going to put it out and see what happens. Oh, that didn't work. back to the drawing board. Okay, let's put this one out, right? It also comes the expense of gas fees and audits and all that stuff. So I think it's very different from traditional building in that way, which is why our team is the way it is and very kind of lean.
Right. Right. Yeah, I think I'm seeing a lot of people getting impatient over like GMX V2 specifically. And it's like when you think about like how long something like that has been around versus like how long it actually takes to like ship and how long something successful like Aave has taken, like it kind of helps puts thing into perspective and kind of just shows like how attention spans have become the way they are.
Oh yeah. Yeah, attention spans are getting nuked in crypto these days, actually, unfortunately.
Yeah. But we could do a whole nother 5 podcasts on that one, I'm sure. But for now, I think it would be good to segue into Abacus specifically. If you could maybe start out with like a quick, like high level summary of how it works, maybe how it differs from some of the other lending protocols and where you kind of see it fitting into the landscape right now.
Yeah, so what Abacus is we like to call ourselves a very borrower friendly lending protocol. So what I mean by that is that if you look at the way we operate, a lot of it on the surface kind of seems more on the side of the borrowers than of the lenders. So what do I mean by that? I mean, if you look at the terms for liquidation, it's easier for the borrowers, right? The lenders put the money in, and if the borrower gets liquidated and it sells, then a lender will just get slashed without any. There's not really much they can do once they're locked in. Whereas the borrower, they can pay back the loan as long as they pay it back on time. If another lender comes in, then the loan just automatically extends. So the borrower has a little bit of an easier time where they also, and this will segue into something else, they also may get a lower interest rate, right, that they have to pay than elsewhere. And just overall, the end goal is to actually get them a higher LTV or better mark to market. Whereas for the lenders, right now at least, it's more kind of like a traditional lending experience. I think it is unique in that lenders can actually pick their lending, the valuation that they decide to lend at, right? So if I'm a lender, and this also segues into how it works. If I'm a lender, I come to Abacus and there's different pools. So we call them spot pools. And a spot pool can have anywhere from 1 NFT in it to 50 collections, entire collections in it. There's no limit on how many could be in there. And when you create a pool, you submit a Merkle root. So, if you want to, adding in 1 NFT or adding in 10,000 NFTs is essentially the same cost. And so the way it works is that when you look at a pool, what you're valuing when you value the pool is the value of the lowest NFT in the pool. And so for now, we've only created 4 pools. And so, for example, we just opened up a Milady pool. And so what happens is if you're a lender, you go to that Milady pool and you say, I see that there's these price ranges I could enter in at. I could enter in at the 0.1 ETH price range. So basically saying, I think Miladys are worth more than 0.1 ETH. And not only do I think they're worth more than 0.1 ETH now, but when I choose how long I'm going to lock my liquidity for, I'm saying I think they're going to be more than 0.1 ETH until my liquidity unlocks. That's the bet that you're making it as a liquidity provider. And so what you do is, because they're broken up into the tranches, you can enter whatever tranche that you think it'll be worth. So if you think they'll be worth more than 2 ETH for the next 10 weeks, you can enter a tranche that's at the value of 2 ETH. So it's from 1.9 to 2 ETH. And what you get in return for going up higher on the value pole, let's call it, or on the value chart, is you get a better return than someone who took the much safer one of the 0.1 ETH value. So you get a risk-adjusted return. And in doing that, what happens is that as more LPs fill into these different tranches over time, it aggregates into a single, very simple value that a borrower can come and see. Borrowers don't know how many LPs are in there. They could care less. They don't even know what the valuations that they're in at are. A borrower just sees, this is how much I can borrow. And where does that number come from? we have this notion of collateral slots. So a collateral slot can be thought of as, or the amount of collateral slots can be thought of as the borrow capacity of a pool. And what happens is that you take the total amount of liquidity in the pool, irrespective of the valuation tranches that they're in, and you just divide it by the amount of collateral slots, and that's how much a borrower can borrow per NFT. And so part of the reason we have it like that also is so that it completely separates the borrower experience from the complexity that is the lender experience. And so that's the way it works. And so why do I think it's different from what exists now? I think for a few reasons. One, the pool is in a unique position, or spot pools are in a unique position because they can offer lower rates, period. Why can they offer lower rates? The reason why is because with this risk adjustment that happens, or we can compare it to normal models first, and then it'll make more sense. So there's two basic models that exist, right? Peer-to-peer and peer-to-pool. Peer-to-peer is, we know it's the one-to-one, right? So you go to NFTFi, you go to Arcade, you go to X2Y2, wherever, and you look, okay, here's a peer-to-peer loan someone's offering. Or if no one's offering, you say, hey, I'm going to list my NFT, I want to get a loan. And then what happens is that the lender then comes in, fills your loan. Now you have the money, the NFT's custodied, you have some interest rate you have to pay over time, and you have some due date. This isn't traditional peer-to-peer. And so what happens is that because it's one-to-one, more obviously, right, the borrower takes on the entire range of price, or the lender takes on the entire range of price risk. So if you're a borrower and I'm lending you 1 ETH for your NFT, I'm taking that entire price risk of the NFT that it won't go below the value of 1 ETH, right? So I took the entire risk there. In peer-to-pool, the same thing is happening. However, it's just democratized. So let's say you have BendDAO, right? So whenever someone deposits liquidity into BendDAO, they're taking the entire range of price risk for the movement of punks, right? The movement of apes, the movement of Azuki, and whatever else they support. Why are they taking the entire range of price risk? Because if an NFT sells for below what was lent at, that loss is democratized by all the LPs, i.e., all of them experience a loss because of that price was incorrect. Okay, so those are the two kind of basic models. So why are we different from both? The reason why is because with the way of tranches and risk-adjusted returns, what happens with us is that the lenders or the LPs, while they're still offering something similar to peer-to-pool in terms of you can deposit, you can borrow, you can repay, you can do whatever you want, and you don't have to go find the lender, right? You don't have to go to do the P2P equivalent of seeking out a lender. But the lenders themselves are taking on concentrated ranges of price risk. So what does that do? And first of all, what does that mean? That means that if there's 10 lenders, and let's go back to the Milady example, right? Let's just say there's 2 lenders. One lender decides I'm willing to lend at 0 to 1 ETH because I'm more risk averse, so I don't want to take too much price risk. Another one comes in and says, this guy, I'm going to get a much higher return than him because I'm fine. I think it's going to be worth more than 2 ETH. So what do I care if I lend more than 2 ETH? All I see is I'm getting more return. And so what the lender gives, or what the second person gives to the 1 to 2 ETH, they're taking on that edge of price risk. And so what does that do? Why does that lower the APR? The reason why is because now, as a borrower, you don't have to pay the entire liquidity worth of lenders for the edge of price risk. So what do I mean? I mean, in the case of peer-to-peer, it's more obvious because it's one-to-one, so that one person is taking the entire price risk. But in peer-to-pool, let's say you're borrowing 48 ETH for a punk. that entire 48 ETH, because that entire 48 ETH is exposed to the price risk of that punk at whatever value you borrowed it at. So at 48 ETH, which means that all of that 48 ETH needs to be paid an interest rate that will make it worth lending. In our case, let's say the same case of the Milady, only one ETH out of the 2 ETH that's being borrowed needs to be paid the edge rate. The edge rate being the rate that you would get at 2 ETH. Meanwhile, the 0 to 1 ETH can be paid a lower rate because they're not taking that same risk. And so what you're able to do is take from the lower rate. I mean, it's just essentially like in an intuitive way, take from the lower risk, give to the higher risk, and then give the borrower an overall lower interest payment. Because you're just by adjusting the risk properly, you're taking from the people that are taking less risk, giving to the people that are taking more risk, but the absolute interest that needs to be paid is lower in our case. And that's one of the things that we really want to accomplish. And that's why we consider ourselves borrower friendly, right? Because we're trying to really bring those rates lower. So that's one. The other is just the friendliness, right? You get the friendliness of a time-based liquidation with the what's it called? With the convenience of a peer-to-pool speed of taking out loans and just kind of loan offering in general. So I think that hybrid also is what is very different than what exists now. And so where do we fit into this lending landscape? The truth is, I think there's a ton of lending, like there's a ton of people lending, a ton of people exploding in this lending landscape. One of the things that I think about is there's someone who's very smart who said this, which is that if you're going to build a system, like a large scale system or just a system in general, if you want to see if it really works, what you need to do is you need to multiply out the system. And he was talking about a hardware system that he was building, but you can extrapolate this to whatever you're doing. So I'll do it with lending. You need to multiply that system by a unit of 1,000, right? Or you need to multiply it up to 1,000,000 units, or in our case, let's say $1 billion of lending demand. And you need to think to yourself, if we needed to put through $1 billion worth of lending demand, would this still work? And I think if you look at the existing protocols, I'm not going to name names because I don't like doing that, but if you just look at the existing protocols, and a lot of P2P, it's a very predatory in terms of lenders and borrowers. So you may have 10, 20, $30 million worth of liquidity willing to borrow at 30 or 50% APR, but it's unlikely that you have $1 billion worth of liquidity willing to borrow at 50% APR, right? There are others that have other ways of kind of trying to subsidize this. And again, you multiply that demand up to $1 billion, you can't subsidize that $1 billion forever. And it's like just a ton of bleeding money. And lastly, right, it's just even without the subsidies, just the convenience of it doesn't really work out so well, like with the more slower peer-to-peer models. And so I think with us, I think we're uniquely positioned where if you were to take our throughput or the demand and multiply it out to $1 billion worth of demand, everything functions the same. Everything functions as intended. Nothing really changes. Like we have no required subsidy. I mean, we put out this announcement earlier today, but that's not something that we're going to do for the long term. That's just for the beginning, right? We have no required long-term subsidy that would limit how much we can take, how much throughput we can take. We have no like kind of trick that we're playing or whatever it is where, we're trying to charge 50 or 60% APR. So, I think even 9.5% could be high, maybe 7% or whatever that number would land on. We can support that while still, as I mentioned earlier, giving the higher risk takers, still giving them the 10, 12, 15%, whatever they want. And so I think when you scale out the liquidity in our case, whereas I don't think this is necessarily true elsewhere, I think you kind of I think it still works, right? Obviously, it's all theoretical, but it just nothing breaks, right? It withstands a theoretical stress test. And so I think that differentiates us, especially when, if you kind of tie in this personal theory that I have of where NFTs need to go to really make this lending stuff make sense and really make NFTs kind of reach some level of what their potential may be.
Awesome. Great stuff, man. Lots to unpack there. One of the things that I've been looking at specifically within DeFi as recently as examples of compartmentalization of risk or of liquidity provisioning to increase like capital efficiency. And I think that this is a really, at least within NFT fi, this is one of the first like super poignant examples I've seen. But one of the concerns that I think comes along with that is when you increase sophistication for LPs to a certain degree, the more you do it, the more, I guess, the more like complex of an LP you start to target. And I think that you guys obviously aren't on a super extreme end of that, given that your tranches appear to be pretty friendly and reasonably understood in layman's terms. But I do think that there is like somewhat of a barrier here to entry for LPs. Do you view that as a particular issue in the long run? Do you see that as something you'll need to address? And if so, like how do you plan on making it as easy as possible for LPs to come in and give out loans that are fit to their risk profile?
Yeah, sure. So I think we have some things that will be, these are kind of like we have two ranks of things that we work on. So one is the more immediate things. So for example, some of like this V1.1 was like a more immediate one that we wanted to get out, and some of the other stuff like the interface changes. Then we also have the much larger scale things that we take on, like the bigger undertakings. So the next one, which would be called V2, but won't necessarily be out for a little bit. That is something that addresses that, one, on the side of the LPs, but two, in making the LP experience better, it allows us to create a much more intuitive interface and just usage, where it's like it basically black boxes all of that complexity. But so that's one. But the second one is that I think, as much as we love retail, as much as everyone loves retail, in these DeFi markets, someone who has $5,000-$10,000, they'd come in and use it. And crypto retail is incredibly sophisticated compared to real retail. But I think if you look at Aave, right, or you look at Compound or any of the other large kind of powerhouse DeFi protocols, a lot of the lending, a lot of the LPs for the ones that really sustain, right? I'm talking about the big ones, Uniswap LPs or whatever. A lot of them are very sophisticated institutions, whether that's the VCs propping up the protocol or whatever it is, right? That's the money that sticks, which is that, yeah, even if yields aren't great, they have billions of dollars to deploy, or billions of dollars worth of assets to deploy, or hundreds of millions of dollars worth of assets to deploy. And they can't go deploy that trading shit coins. They can't go deploy that here or there. So they're going to go find that place, which is giving them that 5 or 6 or 7 or 8%, and they're going to deploy it there. And not only is that the largest amount, and I think the vast majority of liquidity that exists within these DeFi protocols, but I think it is also the stickiest, right? And kind of sticky is the big word in these protocols, which is that the stickier the people you have, you want, like, this is just kind of on a customer targeting, right? You want DAOs, you want VCs, you want institutions who have a little harder time just ripcording money when things go, or to go trade Pepe token. And so while I think that it is a little confusing, I do have this kind of thesis, which is that in the long run, right? Again, you're going to scale to X amount of units, a million units or whatever. A large portion of those million units will be made up of institutions that are seeking returns. And that's why, so in the short run, that's why we're very focused on, this is also paired with another thing, which is right now, even though people think it's a lender's market, I personally think it's a borrower's market. where, lenders are chasing borrowers. Borrowers aren't always chasing lenders as much, unless you're in like a super long tail asset, in which case then it's a little different. But yeah, that's what I think about it. Which I think is I think it definitely is complex. I think there needs to be some base level of complexity that will exist there. And I think that the end state of the mass amounts of liquidity that will enter this, if it does, which I think it will be some sophisticated players. It won't be the majority, won't be kind of retail that's just kind of sitting in these pools.
Yeah, that's a great point. I think thinking about, like, I haven't thought about the most sticky liquidity in DeFi much, and you're right, it is those institutions. And in my mind, I mean, I don't think I was there for that hurdle per se, but I'm curious what you think, what the hurdle for those big institutions to kind of start getting into DeFi was, and what you think that hurdle will be for the NFT fi ecosystem before we start seeing that institutional level thing.
Yeah, so I think one is one is right. You want sticky, but on the flip side, if someone's gonna give sticky liquidity, they need to be able to be quote unquote, let's say like AFK, right? They need to be able to be idle, which you can't do in peer to peer. You just can't, right? You have to be active. You can't really do so much in peer to pool right now. It's just like with the way the markets move, one, you don't even know what the return you're getting is. Two, you don't know if things are going to crash on you. And three, it's just, well, three, not that last one, but three, it just needs to be more mature. So if they're going to lend out their money, right, they don't want to get some shit coin in addition to 1% of a real ETH return. They want all real ETH return, right? Because they don't want to have to deal with going to offload, especially, if you're lending $10,000, $20,000, fine. But if you're lending $50 million and you're getting $1 million in shitcoin, you have to be able to unload that. And you don't want to deal with that, right? Like you're already taking enough complexity coming into the NFT lending space of trying to determine what's the best lending price. You don't want to have to then figure out how to offload this stuff every so often, or, just want to go somewhere and again, you just want to be able to be sticky. You just want to be able to put your money there, go there every month, collect your check of ETH and leave, and then come back the next month and do it again. And I don't think that really exists. That's part of that doesn't even exist with us right now, right? The longest you can lock is for 10 weeks. Part of what we want to really focus on in that V2 that I mentioned is allowing people to be sticky like that also. So, you just come in, you leave your stuff there, and you just come back, take your profits and leave whenever you want. So, but I think that's three. Four is just, someone said this to me before, which I was looking at the LTVs of different DeFi protocols. And I was thinking to myself, I was like, how the hell does Aave still have multiple billions of dollars worth of liquidity there? Like at this point, there are some pools that are earning 2-3%. And it's, you can go anywhere else and earn 5%, 6% in like reliable ways. But how could Aave still have that much money in there when they're losing, right? 1% on 10,000, again, 1% on $10,000 is $100. 1% on $10 million is $100,000, right? So it's two very different. And let's scale it up. 1% on $100 million is $1 million. So huge differences per percentage point. Yet they still decide to forego it and stay there. And why are they doing that? And this isn't like some intuitive thing that I came up with, because I was really complex. I was confused by this. So someone told me the reason why is just the risk premium, right? Like, yeah, we talk about the risk of the NFT price dropping, the risk of this, the risk of that. But what about the risk of a hack, right? Like Euler went forever. They were all fixed up. They were all audited. And then boom, they just got hacked for 280 mil, 270 mil. It's lucky enough that he gave the money back. But like, that is a massive risk premium. And with the more money you have, especially if it's not your money, right? Especially if you're a fund who's handling other people's money, that avoiding that risk and going somewhere which has been battle tested for 4 years now, or 3 years, or however long these things have been out, going there and earning 3 or 4 percentage points less, or whatever, is worth the risk that is worth foregoing the risk of going to some new protocol, which all of NFT-Fi is new. All of NFT-Fi in the way that it can be sticky, at least, right? So you have kind of two constraints there, is new. And all of NFT-Fi in general is new in terms of the rates that you can earn. And then again, the final problem is you just can't deploy $10 million, $20, $30 million in a way that will earn you that money, right? You can't do that in P2P, right? There's not $20 million or $10 million worth of outstanding loan requests currently for 50% APR or 25% APR. There just aren't. And so, when you're managing these massive funds, you don't want to empty, think about it. If I have $1 billion, if I'm managing $1 billion, and anything I do, I can empty out at most a $1 million clip at a time, I need 1,000 different things to do. 1,000 different things. It's hard enough to find 4 different things, right? They get paid the big bucks for finding a few different things, but they would need to find 1,000 different things, all of which have mitigated that risk premium. Just to deploy $1 million, even to deploy 10 million, they need to find 100 different things. And there are not 100 different things. There aren't even 100 different protocols in NFT-Fi. And so I think those are some barriers that need to be overcome. One of them just comes with time. The other one comes with the protocol mechanisms that exist. But I think those are significant barriers, and I think they need to be. I think first the market needs to be fixed. It needs to go away from being such a predatory market, so borrowers will come in, and also so lenders are kind of forced, right? It's like a balancing act. The more borrowers that come in willing to pay lower rates, the more lenders may capitulate and say, you know what, I can earn 50% on $100,000 or 10% on $1 million. I'll take the 10% in the same amount of time. And so I think those are some things that need to happen. But there's definitely a lot of, it definitely needs to grow. There's a lot of ways that this needs to grow. The asset class itself needs to get a little more stable. I'm sure people will come up with pricing models as time goes. Our goal is that, you don't need a pricing model, which is kind of what we want to do, which is that you could take, if you're someone who's just chasing a safe 5 or 6% risk, you don't even need a pricing model. Just go in the lowest tranche of punks or whatever, and you can earn that without any risk of taking that top side price. So I think those are some barriers, and they're significant ones, but every industry has their significant level of barriers, and I'm sure there are plenty of ways, I think, to overcome those.
Right. I mean, considering how long it's been since, I guess, something like NFT-Fi, the platform launched, or I don't know, maybe like BendDAO, we really haven't been given much time for that maturity to really take place. I think it's interesting how the idea for Abacus kind of spawned from putting real world assets on chain, or specifically being able to conduct financial transactions with them via DeFi, because I think that kind of brings into question what your long-term view of NFTs maturing, NFTs changing throughout cycles looks like over the next couple years or so. I don't know. Me and Cedo were arguing this morning about Blur, specifically about what Blend is doing for the NFT-Fi space and for the NFT space as a whole. I'm wondering, this is 2 big questions. Number one, what specifically do you see the near to midterm future of NFTs looking like? And how do you see NFT-Fi influencing that, with kind of Blur being a backdrop of whether or not that's something that's a net positive, a net good for the technology, for the space in general?
Yeah, so let's kind of try and navigate those one by one.
Yeah.
So I think the first question, just to clarify, is where do I think NFTs are going to kind of go in the short term? And the second one is, what's going to happen in the long term, and what are the effects that it has on NFT-Fi?
Yeah. I told him a little bit about your last pod, the Goblin Sachs guys. I was talking to him a bit about your take that, and this was 5 months ago, 6 months ago. So it had time to, your thoughts kind of had time to develop. And you mentioned a bit about a NFT Hiroshima coming to the market. And I mean, I guess you could say that some of that
I mean,
what
it's happening
actually
now.
happened and is happening. Yeah, like you'll see like Moonbird just like completely lose everything they had going for them, like, and just a bunch of stuff, a bunch of shit hitting the fan. So just curious on like how you can think about the thoughts you had on there, like where they've developed in the past 5 months, and what you see like this liquidity influx from Blend doing to the next 5 months, 6 months, in a year.
Yeah, so I think that so my thoughts have definitely kind of changed quite a bit. So I think this is kind of the Hiroshima moment that NFTs are going through. It's going to last for quite a bit longer. I think that that there's a few things that need to be realized with NFTs. One is that if they're really going to become something that everyone uses and everyone knows about and everyone cares about, right? That's a lot of what matters for NFTs in the state that they are, that people care about them, right? It's very much an attention game. People need to, we need to stop telling everyone that this isn't like if they say it's just a picture and you say, no, it's an NFT, like we shouldn't need to say that. I understand why that feeling is there, which is that we want to educate everyone on what an NFT is, but it's much easier to just say, no, it's a collectible. It's a picture. Yeah, it's a collectible picture. Right? It's a picture. Yeah, it's a playing card. But no one says that. Everyone goes, it's an NFT. And the thing there is that how much harder is it to grasp the concept of an NFT? For me, at least, it took a 40-page paper from OpenSea at the time to really understand what it was and like why I care about it. Versus like, oh, this is a collectible. Great. Where is the collectible? Oh, you own it. You own it online, right? Great. And if they want to know more, they'll ask more. If they don't want to know more, they don't need to. I don't own this pudgy penguin because it's an NFT. I own it because I think it's cute as fuck. Like, and so I think that, I think that's something that people need to really just it's not like a big ideological thing. It's like just internalize like that's what this, these JPEGs are just one form of an NFT. It's a subset of what NFTs are and what NFTs will become. Like that's something that needs to be accepted. And I think that'll be accepted at the bottom, which is like people that are left holding things after it nuked 90% need to ask themselves, why am I holding this? And some people will be like, I don't know why I'm holding it. That's what we're seeing now, right? That's the capitulation that we're seeing now. People are like, yeah, I don't know why we're holding it. Like, you're right. It's just a JPEG. And the other people will say, I'm holding it because it's just a JPEG that I think is dope, right? Maybe I have a sweater with it. Maybe I have it's my PFP. Maybe I have a picture of it on my wall, right? But it's just a JPEG. It's just a JPEG. It's part of this larger thing, this larger technology, which is NFTs, right? It doesn't encapsulate the entirety of it. It's just a subset of it. And I think that's what's happening now, especially as there's like real world things that are going on and real world concerns and real world, I want cash or I want money on hand, who knows what's going to happen. The world's changing, blah, blah, blah. Right. I think that kind of is like a supercharge. It's like a catalyst for this feeling of like, really, why are you holding it? What is this? And I think that's a fundamental question that people always need to ask. And I think that's a fundamental question that comes after any bubble, right? That's what happened after the internet. People were like, okay, people were making these pet dog sites and these plant sites. But like, what is the internet? Like, who cares about it? What's the point of it? And then, we had the 2010s in the past, and the past decade or so, which is like, okay, now we understand what it is, right? We got what it was. It wasn't just to sell dog food, right? It was so much more than that. It's so much more with communication or whatever. And I don't know if NFTs will be on the scale of the internet, but my point is that like NFTs have that same thing, which is like, we're in that, oh, it was just a dog food. Like this isn't just a dog food company, but it's a dog food internet company, right? This isn't just a JPEG, but it's a JPEG NFT, right?
Yeah.
So that's kind of what we're going through now. And I think that, NFT lending, the way I look at NFT lending in its current state, to be honest, is more of a testing ground because of what my long-term view of NFTs is, right? Which is that it's just like it's really just a testing ground for these incredibly speculative assets, like probably some of the most speculative assets in the world. And can we create pricing models that can corral the most volatile assets into a framework where we can lend against. Because if you could do it with those, then you could do it with real estate, which is magnitudes of order more stable, right? You could do it with other sorts of assets, which are just, most of which are more stable. That's how I view it.
Yeah.
Others probably have different views on it, but that's how I view it. And that's the short term. And we can unpack that and then we can go to the long term.
Yeah, I think the argument me and Ellie had earlier today and yesterday mainly focused around like their strategy. And to me, a lot of the ethos that comes from crypto is like a cycle that begins at like degenerate gambling levels of chaos and then matures into something like real and significant. And so to like almost like people that like a mining company that goes mining in the mountains, you don't take a shovel to like a mountain. You throw like a bunch of dynamite into it, and then once the dust settles, you grab a shovel and like you do normal things. So I think what the whole blur thing happening is just fucking chaos. But when the dust settles, what do you think happens with like, do you see any flaws with their mechanism? Do you see any like key points of like failure or differentiation between what they're doing and why you think Abacus is a better version?
Yeah, I think the truth is that I think that a lot of this is an attention game and they have a ton of attention, right? So they're going to get a ton of volume. They're going to get a ton of lending volume, especially because they have the market right there as well. But I think this is one of the cases where if you had to scale that up to $1 billion worth of lending volume, would it still work? My answer is no. I mean, if I'm being completely honest, my answer is no. Because most of the reason why the lenders are there are for the token. And so you need to subsidize $1 billion worth of lending liquidity in perpetuity to accomplish this. Now, is the flip side of that is, yeah, but once we get their attention, we could put something out that doesn't require the subsidy, and that could be the argument, and they could do that. But this thing that came out now is heavily dependent on that subsidy. And if you just look at an example of two protocols that did fairly similar things, but one had one and one didn't, look at Compound and Aave, right? Compound is not nearly as big as Aave, and that's because their subsidy just got, over time, just nuked, right? Like the reward for borrowing, the reward for lending just got destroyed over time. And so I think that's part of this problem, which is that, I think, I don't think it's just them. I think it exists everywhere. And it's also part of the attention problem in crypto, which is like if someone has a token, everyone will go there. And even if it's not just us, even if it's like NFT-Fi, who I know is gearing up to release a token, or Arcade, I'm talking on the P2P side, right? Even if it's them, right? They are now, I mean, I haven't looked, I don't look into the stats so much. I'm mostly just kind of tunnel visioned on Abacus with the occasional look around. But I imagine that a lot of the volume that's going there is being taken or starved from things like Arcade and things like NFT-Fi or X2Y2 or other places where similar things are happening. And I don't think that is particularly healthy, because then depending on how long this lasts for, and that again, this could also be a trick that Blur is trying to play, which is like they just starve everyone else out. Maybe the others just stick around, maybe they don't. The point is they just take a ton of attention by basically just bribing people to come to their platform, and then they figure it out after that, which could work. But yeah, I think the current mechanism is basically just P2P, where instead of the borrowing coming and refinancing, the lenders just refinance. I also think it's super predatory. I think it's the opposite of us. We're very borrower friendly. This is incredibly lender friendly. Just like I can, if I really wanted to, I can offer a pretty crazy loan and then just literally just watch your wallet, and then once you spent the money, just go offload it, like just refinance it, and then either you refinance it and someone else gets it. I can even be that other person that gets it, or I liquidate your loan, which is like super predatory. And so I think there's some stark differences between us. I think the closest similarity is the existing P2P protocols. But I just think in general that doesn't scale very well. I think P2P doesn't scale very well in general. That's why Aave switched from peer to pool. Like they fully switched that, and that's when they took off. So I think that's one problem in general, but I think the subsidy just generally does not work at scale, right? One can scale, one cannot. But then there's just a question of the attention, right? Like, can you get the attention? Can you get it fast enough to where to where it's still doing well, right? Because if they just keep attention and they just build the same thing, right, then they have a mega advantage there. So it's a multifaceted game in terms of kind of where they stack up against each other. But I think the current model, it's a good way to get attention. It's a good way to make your move into the NFT fi world. Does it scale? No, but I'm sure maybe they'll come up with something that does scale a little better. So we'll see. Only time will tell.
Yeah, definitely in agreement with you there. I think the subsidy component can be valuable. It definitely is valuable, but when it's all it is, it creates this unhealthy relationship between platform and user, and you end up with unhealthy, misaligned incentives in the long run, I think. Have you guys thought about at all how or if you were to use something similar to support some sort of a token or some sort of an incentive system?
Yeah, we've thought about it. We'll see what happens in the long run. Wink, wink. But for now, the goal is to get to some level of working product in terms of not only like does it work, but there's like true demand for it before like releasing any sort of token. I think that when you do it like that, the token is levels more powerful than when it is the entire incentive. I saw a tweet today that was basically saying, I think it was talking about Blur's effect on the NFT market. And they were basically saying, and by the way, I may seem like a Blur hater, but I think they've kind of made markets more efficient. There are some not great things that have happened because of it, but in general, they've brought a lot more liquidity to NFTs that existed before and just made it a lot more efficient, which some people may be mad at because they lose out because when efficiency comes, profits go away, but whatever. I don't think that's a bad thing. But so I was seeing someone who said, the Blur token is making the economics of lending change so much, right? Because you have basically someone took out they bought a punk with like 1.5 ETH, right? They bought a 55 ETH punk with 1.5 ETH. And my immediate thought on that was that's cool that someone was able to do that, but it's also like kind of a shame. It's like that's not what this notion of tokens and sovereign currencies was created for. It wasn't created for bribing people and doing that stuff, right? Like this is something you get from reading if you just read a bunch of the early white papers just read Bitcoin's white paper a few times or Ethereum's white paper a few times. Like they weren't built. Bitcoin wasn't built to change how people act economically or incentivize them, kind of trying to get them to act in a non-rational or non-normally economic way. It was built with the assumption that they'll continue acting the way that they've acted in the past. And that's why it would work. So to see that these like new age tokens are kind of trying to break that, one, it just, any token that has tried to do that in competition with Bitcoin has failed. But in a long enough time span. But two, it's just like, as someone who kind of got into it for that reasons, who got into crypto for those reasons, it's like it feels like kind of a shame to me that is the case, which is what I think we're seeing. And so that's what I want to avoid, which is that we're not playing to switch some economic way that people work with the token. It's that we put it in a way which is it's a huge catalyst for the protocol, but it's a huge catalyst in getting people to just act normally, right? Act the way that you would act normally. But this is just an economic catalyst that makes it go faster. That's our goal with it. So we can't figure that out until we know exactly how the product works and like what the one that gets adopted, exactly how that works.
Yeah, you talked a bit. I think your envisionment of tokens and like your ethos, crypto in general, is like really interesting. I align with it a lot. So that's why I'm like pretty excited to even see what you would come up with for like tokenomics or something like this. I know most people are waiting to like just like airdrop farm and fucking run up like points or whatever. But I'm just genuinely curious because you talked a bit about how you like you compared the ABC mechanism or like potential mechanism to ETH's inflation rate. Could you get into that a bit more? Maybe how your thought process has changed as you see like points mechanisms getting more adopted with like Blur and NFTFi, and if you think, I mean, I think your answer to if the points mechanism is sustainable is probably no. But yeah, just how those kind of examples have changed how you think about what an ABC token would look like, or the tokenomics for it would look like, and
Yeah,
the
sure.
hypothetical, of course.
So I think it's like so points are just tokens. Like points are just a way to get around, I think, like legal problems that surround about giving tokens, right? Points are just vested tokens, right? Once you earn the points, you can't trade them, can't do anything with them. You just gotta wait until you get your token for the point. They're actually a little worse than vested tokens because you don't even know how many tokens you're gonna get, right? So, but yeah, let's like that's just like a kind of like a step remove thing, which is seems like a meta, but it's really just you're getting vested tokens. So it's like yield farming, but with a lockup. I think the way I would design a token is once we've identified like this where the product gets to some level of product market fit. You know, a lot of products have a weakness in different areas. So some of them may be adoption rates really difficult, right? So, you know, adoption rate of borrowing or of in a hardware case, right? Adoption rate of getting a computer is difficult. So you have to incentivize that, right? And in the case of a marketplace, right? There's a chicken and egg problem, right? That's why they incentivized, you know, with Blur, that's why they incentivize both sides, the borrower and the that's why the listing and the bidder, right? And in Compound, that's why they incentivize both the borrower and the lender. And so I think what would happen with us is that we would first have to identify, okay, we've hit some level of product market fit, but why haven't we gone parabolic? Right? Like, why haven't we just absolutely exploded? And the reason would usually be a constraint on either the lender side or the borrower side. So once we've identified that, that's kind of where we'd aim the token at. In the way that we would inflate the token, this is how I think about monetary theory. I really don't know that much about monetary theory, so it's just like this is all just like having thought about it a solid amount, but with no like necessarily academic background in it. I think one of the special things about Bitcoin, ETH too, is and even just like the idea of an immutable money, right? Is that people often knock on it because it can't change. And people say like, "Oh, it's immutable" or whatever. They also knock on it because it's too slow. But you have Lightning Network, you can scale that. I think the fact that it cannot change is why it's so special, and I think that's what the novelty of it is. So right now in the U.S., for example, and I'll connect this back to how I would approach with the token. Right now in the U.S., for example, a big problem is, you know, oh, do they raise the debt ceiling? I think they voted to raise it, but you know that was a question. You know, the other is the fractional reserve banking. Oh, you know, the FDIC is going to come bail them out. They're going to do some financial tricks, and you know, maybe they'll not make the taxpayer pay, or right, whatever it is. And even worse things of, you know, oh, COVID hit. Let's print trillions of dollars, right? That's a flaw, right? The ability for people to in the 70s take us off the gold standard, you know, in 2020 now, right, to print $4 trillion. The ability for someone to try and change monetary policy or adapt it to the needs of the time, I think is a flaw. The reason I think that Bitcoin and ETH are, and I mean, those are just the main ones, are so special is because I think the power of it, of money in general, I mean, and this is a much longer conversation of the point of money, but I'll just say this is that the the requirement for humans to to adapt to the money rather than to having the ability to adapt money to the humans' mistakes makes humans a lot more conscious of how they approach the usage of money, which makes the money itself more valuable. Which I don't know if that makes a lot of sense, like in terms of like it just makes sense to me because I've thought about it, but
Yeah.
it
No, it does.
it just right. So that is something that I think is really important, which is that it's not, with the point system and whatever, you basically give the foundation, whatever you want to call it, you give them free rein to just decide, oh, this is loss trading, this isn't, which they're basically deciding, who they're going to give it to, right? Obviously, it's a little more complex than that, but that's basically what's going on, right? They'll tell some people about how the points will work because there's some insiders. They won't tell others because they aren't insiders, right? There's clearly something that Maki, for example, Maki Big Brother knows
Yeah.
that others don't know, which is why he's like taking millions of dollars of losses, but still is going at such a, he's now, I think, one of the biggest lenders. Like, there's a reason to that. There's something that he has offered, something that he knows. Whereas if you have something which is just like completely open, this is how fast it will inflate, this is exactly how the points work, and that is never going to change. And you, as the user or the person who wants the tokens, must adapt to that. That is something that I think is a really powerful kind of base design of a token. So that's one. The other thing is I think inflation is very important, especially if the token has some sort of power. If the token's purely just like an investment token where it's like you'll accrue some profit sharing and that's it. There's no voting, there's no metrics to be kept, there's no nothing, which I think it's called credible neutrality or whatever. That also is something of value, which is you want to limit how many decisions a DAO needs to make, because the more decisions it needs to make, the worse that it gets at them. But I think that inflation is important for two reasons. Or I guess, yeah, two reasons or three. It's more just a comparison against non-inflationary and deflationary. Deflationary, it's great for the price, but if you have any sort of power that is used to vote, it overall just consolidates, right? The person's benefit is not to sell, and in terms of Ponzi-nomics, it's great, but it's not usually great for the protocol when all the power just gets consolidated by people buying it up over time because they have no incentive to distribute it. So if you want to have distributed ownership, you don't necessarily want deflation. Stagnant is fine, and with inflation, you're losing out on this too. With deflation, you're losing out on this too. There's some phenomenon, and I haven't studied this enough to know exactly what it is and why this is true, but for some reason, there's some like phenomenon that exists in the world, which is inflation, which is that I can inflate the money supply by 2 or 3% a year, and there's no like massive consequences. Yeah, when I print $4 trillion or whatever, then things go bad. But like, if I can just stay at a steady rate of 3% a year, then I can basically print money for free, or if not for free, because there's some existential cost, for some existential cost. But that existential cost is usually less than the amount of money I'm printing. And so I'm basically printing some amount of free value, which is like a weird thought, but it's just the way that it has worked for the past 100 or however many 100 years, which is that there's some fine line, and it's a really fine line. If you cross it, it gets bad quickly, as we've seen. But there's some fine line that you could walk to basically continuously print free money in a steady state for an extended period of time. And to stay stagnant or to be deflationary without any sort of inflationary pressure on things, you're losing out on that's lost value, right? That should even be thought of as a loss. And so I think that's also an important thing to have also. But it's a fine line, so you want to get it right. But getting that right is super powerful, I think. Because then you can just constantly offer, these rewards, this continuous incentive to hit whatever the problem that you've identified to exist was, right? You can just have it run in perpetuity. And then you just have that inflation rate. And then again, people adjust to it. The protocol adjusts to it. Incentives adjust to it. So that's how those are the few base models that I would kind of add together to make, or at least to start the creation of a token.
Yeah, I think that's a very like powerful way. Like I feel like most tokenomics don't get enough thought, especially at like early stages, and I really like that you're like taking it in depth to like the foundation of like everything in the space. So that's a good sign. Another question, I there's a few people in this space that I feel like fit a general category of like ethos and like the work they do that I enjoy a lot. Whether it's in like the DeFi world or just like the very like high level Ethereum space. People like the guys that like Redacted and like Sammy. I also think you give me a lot of like the same vibes as Sammy from Redacted. Do you know who that is?
Yeah,
Yeah.
we've spoken a few times.
Yeah, I just feel like you guys are very similar. I'm like, well, they haven't been in the same, I haven't seen them in the same place before at the same time, so maybe. But I was just curious about like where a lot of your time has been spent in the crypto world. Like, what kind of discords are you in, if you're in any of them? Like, where do you participate? Have you done any like contribution to any DAOs? Like, what kind of projects have you like really liked and you've enjoyed seeing them grow?
Yeah, so I think one of my fatal flaws is that I'm a social person. Like I like hanging out with people. I like talking to people, but I'm like I don't necessarily seek it out. So, for example, if you were to like leave me in my room for, a few weeks with some books or some things that I wanted to read and get through and food, like I would have no problem just sitting there and doing that for 2 weeks, which is like, it's nice because I could focus on those things, but it's not great in like a more social space where like, I from very early on when I really started getting into the space and started working on Abacus, like I had very strong connections to like a bunch of different places where I probably could have gotten in the like private Telegram chats and this and that and go to this party or that party or meet this person and like, but that's just like I don't know. I don't consider myself an insider, and I don't have like a yearning to become an insider. So I never really pushed that. Which if I did, I think it would make a lot of things a lot easier. Like in terms of just like it just many ways, but I just never did, which I definitely think is a little bit of a flaw. So yeah, I never really was kind of hung out on those things. I started hanging out in the Pudgy Penguins Discord a bit more, but I got super busy recently, so I don't as much. But that's just like a great group in there. And then in terms of contributions, I've helped a solid amount of founders of projects think about things and think about mechanisms, but I don't think they'd want me to mention that. But yeah, I mostly, in terms of in the space, I spend a lot of time coding. I spend a lot of time thinking about Abacus. I spend a lot of time trying to think about the larger, more base like foundations of the space. I've read a lot of Nick Szabo's stuff, which is like isn't necessarily you may not think that it's necessarily directly related to the space, but he talks about things like artifacts of wealth. He was the first one to write about smart contracts. He wrote it in 1999. He writes about the origin of money, which is like if you
Yeah,
read that and then you look at proof of work, you're like, wow, this is so similar, and it makes you think, right? To see Satoshi, but that's where I spend a lot of my time is like, because that's what really intrigued me in the space. It's just like that foundational stuff. So that's what I really try to focus on is like just is those things.
yeah. And like in such a niche part of like a whole industry that may or may not even have a future or legs, where do you kind of get the conviction? Where did you get the conviction to say, fuck it, I'm gonna build this thing?
Yeah, I mean, it kind of is just it's like a mix of a few different things. One of them is that I'd rather build it and fail than have just like wrote it off, from the second I saw it and be like, nah, it's an idea and there's just like clearly a curiosity enough for me to spend a significant amount of time working on it. But I just, forgot about it because, I'd rather see it fail than just have like a lingering thought of, oh, what if I did that? What would have happened? That's one. Two is that, and this is I think a very powerful thing that I meditate a lot, so it kind of helps me. That's not what the thing is, but it's just like I say that because it's like when you like slow down your day. I don't get to do it every day, but when you do it a solid amount, you kind of learn how to become a little more conscious of things that are going on. And I think one of the things that you can find is that when you build something like this, or really when you build anything in general, this just happens to be what I'm building. If you really pay attention to what you're doing and you're really kind of present while you're doing it, there's a lot of compounding effects that you can have. There's a lot of compounding benefits that you can build, whether if you're a dev and you're coding, whether if you're mainly a dev and you're coding, but now you have to, kind of market it to people, you have to create certain relationships, whatever. All those things that you learn, even just down to keeping docs, right? Keeping the financial statements, working with the community, all these things, they all compound in whatever you go to next, right? So at the very least, understanding the power of that, which is that most people don't have that for a long time, if ever. Understanding the kind of the power of like having these compounding experiences when I'm kind of young, so when you're my age and just in life in general, and then also building something that you enjoy building something that you think is cool, building something that you think is worthwhile. Kind of, you need to have your own thesis on it. I have my own thesis on this, which is not just, it's like the idea is that it just becomes a larger space because we move away from like trying to convince everyone that an NFT is so special and just like kind of build things that make people's lives better without them having to even know what an NFT is. Most people don't know what the way computers run. They don't know what a microprocessor is, right? They don't even know what silicon is, but like they don't give a shit. Right? They're just using a computer. They're logging onto Instagram on their phone. They don't know how it works. They couldn't care less. They don't need to know everything about what's going on. And so I think having your own thesis, which interests you, makes you want to work on the long term, but also understanding those things of the benefits that you get from really sticking with something or really working on it for quite some time. That's what can keep you going.
Awesome, dude. I really appreciate you coming on. Took a lot of your time here, so I appreciate you coming on and
No
giving all
problem.
those
I appreciate you guys
explanations.
having me.
This was awesome, dude. I really like, you as a person, what you're doing, and I'm excited to watch Abacus grow.
Thanks, man. I appreciate you guys having me on.
Thank you, man. Great stuff. It's been a pleasure.
All right. Peace.
Appreciate it. See ya.
All right. Peace.